Hi, good afternoon. Welcome. Today we're going to be speaking with Dave Hudak concerning how to select an investment advisor, the Essential Guide. Today's webinar is brought to you by Portfolio Evaluations. As mentioned, today's speaker is Dave Hudak, Senior Consultant and Director of Compliance here at PEI. Dave comes to us today with over 10 years of experience in the retirement industry. Today's session will be recorded and available for distribution after the presentation. Right now you are in listen-only mode. However, we do encourage you to send questions via the chat box up on your screen at any point during today's presentation. There will also be time for question and answers at the end of today's session. And with that, here's Dave.
Thank you. Before we get started today in the presentation, first I wanted to start with questions that we often hear when plan sponsors are looking to hire an investment advisor. So oftentimes they'll ask us what our experience is, how many clients do we have, what certifications do we have, CFAs, other sort of industry designations, how many employees we have as a firm. Will we be a fiduciary? It's always an important question to ask. How are you going to get paid? Please provide us some references. Now, it's not very often that we hear plan sponsors asking about business structure. Now, in our work as an investment consulting firm, this being our 20th year in business, we've become aware of the various types of advisory relationships that are in the industry today. And with over 180 clients, $27 billion in assets under advisement, we have a very broad business, and we found that it's not very well known or understood from the plan sponsor community, from retirement vendors, from accountants, attorneys, having an awareness of the different types of distinctions that are in the retirement landscape. So that's why we think the most important consideration in hiring an investment advisor is knowing their business structure. So our objectives for our presentation today are first to help you understand the different types of advisors working in the industry today. We'll educate you on how to do an advisor check so you can know, matter of factly, with the type of advisor you're working with or planning to work with, what their credentials are and how they're structured as an organization. So how we're going to do that is by reviewing the fiduciary landscape. We'll talk about the different types of advisors practicing in the industry today. We'll talk about the fiduciary status and possible conflicts of interest and how you can check for some of the warning signs of a possible conflict of interest. And finally, to give you the tools and knowledge so you can actually go and verify the claims and credentials being made by an advisor you're currently working with or looking to work with through an advisor check. As we talk about the fiduciary landscape, what I first want to start with is a quote. And in many cases, we found it difficult to disentangle the services and business relationships of firms that were duly registered or affiliated with other firms. Some corporations may have multiple subsidiaries or business units, each registered separately as an investment advisor or broker-dealer, but these data do not identify these relationships. By comparing details across databases, we noted many inconsistencies and inaccuracies in the information reported. Now, this quote comes from a study that the RAND Corporation did for the SEC, and what the SEC was looking to evaluate was if the retail investor understood the different types of advisors working in the marketplace. And I think this has a lot of parallels to the retirement industry and is very pertinent for our discussion here today. When we talk about the fiduciary landscape, many of us that are in this industry or plan sponsors are well aware of a lot of the challenges faced by fiduciaries today. We're faced with lower market returns, especially after the downturn in 2008, and we really haven't had a lot of recovery since then. We're constantly hearing about the lack of retirement savings on the part of participants in retirement plans. And certainly there's more and more regulatory oversight and fiduciary scrutiny being placed on plan sponsors. So with baby boomers just beginning to retire, there's an environment for litigation, and we've seen some of that over the past couple of years. Major corporations such as John Deere, Caterpillar, Kraft Foods, Bechtel have all been sued because of fiduciary breaches with their 401k plans. And one statistic we have, it's from 2005 to 2008, there was over 2,400 ERISA cases per pensionlitigationdata.com. So there's a lot of activity that is keeping plan sponsors up at night. So when you see and hear statistics like that, it's natural that you'd expect plan sponsors to try and protect themselves. And this has certainly been evidenced by the increased utilization of investment policy statements. We're seeing more and more plan sponsors put better fiduciary governance programs in place and looking to tighten themselves up from a fiduciary liability standpoint. The chart we're illustrating today shows the utilization of investment policy statements from the PSCA survey, and as you can see, the trend has been increasing from low 50% to almost over 85%, and probably increasing since this data was last updated. So as we see this rise in the utilization of investment policy statements and more fiduciary governance by plan sponsors, we're also seeing more plan sponsors partner with experts. As you may or may not be aware, one of the things that's stressed in ERISA is that if you as a plan sponsor don't have the expertise in a particular area, you should partner with an outside expert. So you're certainly seeing a lot of plan sponsors starting to do that, whereas today almost 70% of plan sponsors are working with an advisor. So as more and more plan sponsors begin to work with advisors, the advisor label is sort of a broad umbrella, and there's a lot of different structures that fall underneath that, because for the most part, advisor roles are loosely defined and understood. So how can you distinguish between the different types of advisors in the marketplace and select the one that best suits your needs and responsibilities? There's generally three different types of advisors. The first is a registered rep of a broker-dealer. The registered reps of broker-dealers, how they're compensated by selling investment products. They're also registered investment advisors. A registered investment advisor is going to provide advice on your plan for a fee, for a flat fee. And you also have duly registered firms that will provide registered rep broker-dealer services as also registered investment advisory services as well. So that sort of muddies the water a little bit because it creates some complexities, which we'll get into in a few moments. But with talking about those three broad buckets of advisors, registered reps, the RIAs, and the duly registered firms, I think it's important to note how many advisors fall under these different structures. So I have two statistics, one being from the RAND study that I mentioned earlier in the presentation. Also, the SEC, in a recent study that they have done, so both of these studies corroborate one another. There's about 5,000 broker-dealer firms and about 11,000 registered investment advisory firms. Now, when you hear those numbers, that's just at the national level, and that's just looking at the firm level as well. So you might have a broker-dealer with one or two people under that company name, or you could have a very large broker-dealer firm with thousands of employees, and then obviously everything in between. Now, I did note, too, the challenge with the duly registered firms. The RAND study noted about 550 firms that were registered as broker-dealers and as RIAs, and that's where we tend to find the most conflicts of interest. But one of the things that isn't noted by some of this data, and I've recently become aware of, is, and it's challenging to classify, is that there are registered investment advisory firms that are also affiliated with broker-dealers, but the entities are kept separate, so they're not necessarily duly registered. But again, here's where potential conflicts of interest may exist, and that's why we're going to teach you on how you can uncover this and protect yourselves as fiduciaries. So within the broad set of different types of classifications of advisors, it's also important to understand that based on how an advisor is structured, they have to follow different standards and care in terms of providing advice to you. Generally, there's two standards. There's the suitability standard and the fiduciary standard. And the suitability standard just means that a product or service might be suitable for your particular needs. Whereas fiduciary comes from the Latin fiduciaris, meaning to hold in trust. Now, broker-dealers and registered representatives, they're held to that suitability standard. It's a lower threshold. And if you've seen it in the papers over the past 12, 16 months, there's certainly been a lot of pushback because there's been some talk about putting the fiduciary label on broker-dealers, and there's been some pushback from that industry and actually having to take on that additional liability. So to contrast the suitability standard of broker-dealers, registered investment advisors are bound by the Investment Advisors Act of 1940, which requires them to be a fiduciary and to act in the best interest of their clients. Then with the passage of ERISA in 1974, that set the highest threshold, as it required fiduciaries to act solely in the best interest of plan participants and their beneficiaries. So advisors in the marketplace today will usually be held to one of these standards or hold out their services that don't meet one of these different standards. Now you may be asking why is this important? And it's very important from the standpoint that advisors, when they're having interactions with their clients or potential clients, then they need to provide full disclosure. And they can't provide you with any misleading information. They have to provide you with material facts about how they're structured organizationally. So as we talked about just the different standards that an advisor may follow, understanding that if it ever gets called into question, it's going to be a facts and circumstances determination to really determine is that advisor's role a fiduciary one or not. So some advisors would be very explicit and say, yes, I will take a fiduciary role, and there's others that will not be that forthcoming. So as a plan sponsor, you need to ask yourself these questions. One, have you received full disclosure? Two, are you aware of any other relationships? If so, do these relationships create a conflict of interest? And finally, how do you know for sure? And I can assure you that every advisor in the industry today is going to claim independence and conflict-free. And the fact of the matter is, when the rubber hits the road, the actual advisors that are truly independent and conflict-free is a rarity. So ask yourself these hypothetical questions. Is a consultant conflict-free if it receives less than 100% of its revenue from a fee-for-service structure? Is a consultant conflict-free if its employees are also registered with a broker-dealer? Is a consultant conflict-free if it's only one arm of a larger investment company? So you need to determine if this creates a conflict of interest, and again, it's a facts and circumstances determination. Now, some plan consultants or critics may say that we're making too big of a deal about these conflicts. However, I want to point out why this is really important, because there was a GAO report looking at pension consultants working with plans when they had undisclosed conflicts of interest. And what they had shown is that those plans tended to earn a rate of return of 1.3% less. And I've also noted on here, too, there's two other studies that have been done showing about broker-sold funds underperforming other funds, and also with, even though investor expenses were higher, those funds that had better incentives to brokers received higher inflows. So again, you need to be very conscious of these undisclosed conflicts of interest because of the impact it can have on your plan and your participants. To illustrate this and how this would impact your participants, here's a scenario looking at a participant come to work for you at age 25 over a 40-year working career. They save 10% of their salary, assume they get an 8% rate of return. They would earn over $2.5 million over 40 years. Whereas if you take that 1.3% less, they're only getting 6.7% return. Their total savings is going to be $1.8 million over those 40 years. That's over $700,000 in lost savings because of an undisclosed conflict of interest. So this not only has a huge impact on an individual basis, but then multiply that out over hundreds or thousands of participants in your plan, and think about what limiting effect it can have in the growth of your plan, which can limit your ability to take advantage of economies of scale. So that's why understanding the potential conflict of interest is of such critical importance. So if you're a plan sponsor, what can you do to protect yourself? What you can do to identify these conflicts? Well, here are some easy-to-spot warning signs that should raise some alarm flags if you see them. The first one, if you're receiving consulting services for free or any service for free, you have to think of the old tin staffle theory. There's no such thing as a free lunch. It's not for free. It's getting paid for at some level. Firms that have broker-dealer affiliations or on their websites will say member SIPC or securities offered through in fine print on the website, those are usually telltale signs that there may be a conflict of interest that you need to investigate further. Companies that always recommend the same companies or funds, again, that's a possible conflict of interest. And if you're paying for your services from an ERISA budget or a plan expense account, those plans tend to have higher expenses than they really need to. So what I want to do in some of the next couple of slides, this is just sort of the tip of the iceberg, is show you some actual examples where these warning signs are not so easy to spot. And that's, again, why we think it's so critical that you do this advisor check to really understand the business structure of the firms that you may be working with. And again, I said it on an earlier slide, every advisor out there is going to claim independence. They have no conflicts of interest. They're not doing anything that could impact you from that standpoint. But here's some actual examples we found. The first one being an independent RIA firm also had a broker-dealer name of a different name, so two separate websites for the same firm and the same personnel. But if you visited one website and not the other, you wouldn't necessarily understand that they had these two distinct organizations that they're running out of the same office. Also aware of a prominent conflict-free investment firm or consulting firm, they'll put it all over their website, but if you look at some of the key personnel, they're also registered reps of broker-dealers. Late last year, there was actually some news articles where a prominent investment fiduciary became under DOL investigation for stealing client assets. So as concerning as that is, I was curious and wanted to look into this independent fiduciary structure. So when I looked up this person, I found that not only was he duly registered, but his broker-dealer was a wholly owned subsidiary of a major fund company and 401k record keeper. So I don't know how independent that person really was. And also these preferred provider arrangements. And I'll talk about this a little later in review the ADV Part 2. But there are advisors that have networks that advisors can join, and in return, advisors will push these clients into into these different vendors. So again, it's sort of a quid pro quo relationship, so I'll help you understand that as we go through. I talked a little bit about just lastly the advisor relationships, but also wanted to point out that the investment industry is really geared towards trying to incentivize advisors to gather assets. You can actually find in some mutual fund prospectuses where they offer profit-sharing contributions to advisors who are in the top 50 or 75 sellers of those particular funds. And this is something that's not going to be disclosed to you, but again, if you're having an advisor that's always saying, use XYZ fund company, why are they doing that? Is that there a potential for a profit-sharing contribution they may receive? So it's not just coming from our investigations or what we found, but I also want to point out there's other things that are cited in other examples that have come about as well. The RAND report talked about, similar to what we found with two separate websites, finding a firm that had a broker-dealer arm and an RIA arm, but it didn't make it really clear on the website. They had to do some deeper digging to understand this. They also noted sitting down with a firm that said, yes, we're a broker-dealer, but as they interviewed them, they also found that they were an investment advisory firm as well. Now, one of my favorite reports is the SEC staff report that was done a couple of years ago, where they had looked at 24 pension consulting firms and found that of the 24, 19 to 24 had conflicts of interest. So 3 provided no disclosure, and 16 offered a limited disclosure on those conflicts. And the icing on the top of that cake was many didn't consider themselves fiduciaries. So that's, again, why it's so critically important you do this type of analysis and search work on your advisors. Also, what I find scarier is the GAO report, which also kind of dovetailed on the 2005 SEC report, and they talked about how some of these consulting firms that they looked at were very adept at avoiding fiduciary status. They even noted that it was very rare to find a consultant willing to acknowledge fiduciary status, and that some were even being able to ignore it or just avoid it entirely through the investment advisor agreements. So again, not to really browbeat you too much more over these conflicts of interest, but in an earlier slide I did say that it's important that you have to ask yourself these questions. Have you received full disclosure? Are you aware of any of the relationships? And if so, does that relationship create a conflict? And how do you know for sure? So next I want to transition into showing you some steps that you can take to be certain that you know the advisor you're considering working with or currently working with today really has your best interest and your plan participants' best interest in mind. The Internet is our friend. I've highlighted on this slide the first two being the SEC advisor link, and then below that the FINRA broker check link. So you have these two websites where you can easily do some quick searches on advisors in the marketplace today. And the other two, the DOL fiduciary responsibilities link and the DOL link for selecting and monitoring pension consultants, are just good points of references for plan sponsors. And finally, Google. We're not going to talk about how you go through the search engines, but when you go through a search engine like Google, it's great to understand the prominent participants or parties within these organizations in terms of recent speaking engagements, who else they're affiliated with. I talked about that firm that we found before with the two separate websites. The reason we found the two separate websites is because we found that one of the key players was doing a speaking engagement under a different firm name that we weren't aware of, and that's how we stumbled across the same firm with the two different websites for their two different businesses. So I want to show you how you do an advisor check, starting with the SEC link that was at the top of the previous page. So when you come to the SEC link, it's going to allow you to search on advisors. You can search on an advisory firm, or you could search on an individual. And it's actually a requirement for registered investment advisors when they're working with a prospective client that they actually give them their Form ADVs. And what we have found is that oftentimes plan sponsors do request that information, but I really don't think they understand exactly how much valuable information is in there that they can use to easily spot any potential conflicts of interest. So the Form ADV, there's a lot of information in there. I want to highlight some of the key things that you should be aware of. Item 5 talks about information about your advisory business. Item 6 is other business activities. Item 7 is other financial industry affiliations. Item 8 will talk about you're going to get paid from client referrals. 11, disciplinary information. And then Schedule D will show you outside business information, similar to Item 6. And the best way to show you how to do this is let's look at some live examples. So in this first example, we're going to the information about their advisory business, Item 5. So in this firm's noting that they have 11 to 50 employees in total. They're also noting that they have 11 to 50 of these employees are registered reps of broker-dealer. So first thought that comes to mind, probably a duly registered firm. So let's do a little more investigation. The next thing we want to do is look at Item 6, which talks about their other business activities. And interestingly, they don't note that they're a broker-dealer or a registered rep of a broker-dealer, but on the previous Item 5, they said all their employees are also registered reps of a broker-dealer. But it does note here that they do sell other products other than investment advice. And then finally, if you look at Item 7 of other financial industry affiliations, again, they're not noting any broker-dealer affiliations or anything of that nature. However, they noted that on Item 5 that all their employees were also registered reps of a broker-dealer. So again, this needs to raise the eyebrows of any plan sponsor saying, okay, what is the relationship here and what is the possible conflict of interest. So that's a question you need to raise to that firm if you're looking at the firm or working with this firm. A second example, and we didn't show this in the first screenshot of the ADV form, but there's also what's known as Schedule A. And the reason we like this Schedule A is because that'll show you the owners within a particular organization. And what you want to do, we have it circled there, and that will give you the CRD number, because what's happened sometimes is you might have John A. Smith affiliated with a registered investment advisor, but John Smith is registered with a broker-dealer. Now, the only way to know that that person is the same person will be to search on their CRD number. So very similar to the front of the search screen when you go to the SEC website, you search on advisor rather than advisory firm. You punch in that CRD number, and here we have a screenshot of an example, and this person just happens to come up that they were not only affiliated with a registered investment advisor, but they were also affiliated with a broker-dealer separately as well. So if you just searched on name alone, it wouldn't necessarily come up. That's why it's important you do it with the CRD number. The final example I want to show you with the SEC ADV forms is looking at Schedule 2, the Part 2 brochure. And back in 2011, the SEC revised their format. It used to be a yes-no check the box, which I thought was a little bit easier to answer. It's now supposed to be in a plain English format. So not to offend the legal community out there, I've read through a lot of these, and I think plain English is a lot different to the general public versus it is a lot of lawyers. So the new format can be somewhat challenging to get through. But one of the things I noted earlier in one of the earlier slides about these preferred provider relationships, in going through some of the ADVs of these quote-unquote independent firms, what you'll see in there is that they'll specifically recommend their clients use a specific broker-dealer. And that's, that these quid pro quo relationships. So again, you need to be very cautious and keep it at arm's length. Hey, what really is going on here with a potential conflict of interest that may occur? And just to highlight, again, on the schedule, the Part 2 of the ADV form, one of the reasons that it was required to change, and this is in the Federal Register, that it's really specifically to identify conflicts of interest. So when you read through that, if there is any potential conflict of interest, the advisor should be explaining it to you there. And again, it's a great first resource, and if you have additional questions, you should go to that advisor and ask them to explain it in greater detail. If you're working with a registered rep of a broker-dealer or a duly registered firm, we also suggest that you go to the FINRA site to do some background checks as well. The one nice thing about FINRA is if there is any disciplinary action against the firm, it's going to be detailed here, and here we have a circle showing you that if there is disclosure, it's going to have a detailed report. So you can pull that up, and that detailed report will actually list the infractions on that broker-dealer. So if a broker-dealer has any skeletons in their closet that they haven't told you about, you go to the FINRA website, and you can easily pull that information up on them. So those are some great tools that you can use from the SEC and FINRA to do a broker check. And I also want to make you mindful of these are the 10 questions that the DOL and SEC came up with a couple years ago that you should ask advisors. If you're going to partner with an advisor, you're currently working with an advisor. And all 10 questions are very important. I've highlighted a couple here. The first one is just asking them, are they registered with the SEC or appropriate regulatory bodies? And if so, making sure you get that Form ADV from them. And again, they're supposed to give it to you anyway, but be sure you ask and make sure you get that. Also, I think it's very important to ask them, will they put it in writing that they have a fiduciary obligation to your plan? As I noted in one of those earlier GAO reports, that some of their findings were that a lot of advisors were adept at avoiding fiduciary responsibility in their agreements. So make sure it's very explicit in the agreement you have with them that they're willing to take on fiduciary responsibility for your plan. And also, do they consider themselves to be a fiduciary? Remember, you have that hierarchy, the suitability standard, the fiduciary standard, and the ERISA fiduciary standard. The ERISA fiduciary standard being the highest threshold, and that's really what you want to have, is that highest threshold possible for your plan. And really, at the end of the day, a lot of this boils down to, what do you want from your advisor? Do you want someone who's doing a lot of other things and might have some conflicts of interest? Or do you want someone who has no other ties and is looking out for your plan participants and your best interests exclusively? Because, again, it's the most important consideration you could ever have when finding or hiring an investment advisor is really understanding the business structure. So hopefully this webinar is very helpful for you in understanding the different types of advisors today, how to do an advisor check, because you want to be able to verify the claims being made by anybody you're working with so you can truly determine what the actual structure of that advisor structure is. So if you haven't done an advisor check today, now is the time to definitely go and do that. So with that, we'll turn it over for any questions that may have come through the course of the webinar.
Great. Thank you, Dave. We do have a few questions. It looks as though the first two are in regards to the timing of the advisor check, and how long does this process take, or how long should it take?
You can do a good advisor check in about 15 minutes. You can really kind of get a lot of good information in about 15 minutes, and obviously then it might take a little bit longer if you have some back and forth dialogue with that advisor, if there are any potential conflicts that you need them to explain.
And the second one is, how often should I go through this process?
Suggest doing it at least annually.
Okay. And then we've got two questions concerning liability. It says, what if I go through this process and I find areas of conflicts? If conflicts are found, am I liable as a plan fiduciary?
Again, remember that if it's ever called into question in a court of law, it's going to become a facts and circumstances determination. So you as a plan sponsor, and you're hiring this advisor, the advisor is supposed to disclose all that information. But again, I've shown you some examples where that may not actually be the case. So that's why it's important you go through these steps to really verify the credentials and the claims being made of the advisor that you're looking to work with. And I would definitely suggest that you go through this and you document that you actually have done this.
So how do you suggest going about documenting?
If you're going to document it, number one, obviously get the ADV form from the advisor, something to provide for you anyway. If there are any conflicts or potential conflicts, you want to get more information from the advisor or getting some sort of assurance from the advisor on how that conflict isn't going to impact their ability to give you objective advice. I would actually ask that advisor to provide that sort of disclosure in writing. Have them detail to you in a memo or a letter saying, yes, we understand we have a broker-dealer relationship, but here is how it doesn't impact my objectivity with your plan. Again, you want to have that documentation because you have to be comfortable with the advisor you're working with. And again, it's that facts and circumstances determination. Our point of view is you're better off having an advisor with absolutely no conflicts of interest than one with conflicts of interest that may make them not as impartial as they should be or as objective as they should be when they're providing advice to you.
Wonderful. Thanks, Dave. That seems to be it. Feel free to contact Dave or myself. I'm Brooke May, the marketing manager here at Portfolio Evaluation. After the event, should you have any further questions, and as a reminder, this presentation will be available for distribution right after the webinar. Thank you.
Bye.